Okay, good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about the number one options income strategy, which is a covered call. Now, some of you may be familiar with covered calls. Some of you may actually have traded covered calls. But I cannot stress enough how important this option strategy should be for your portfolio, especially if you own some stocks in your portfolio. There's a reason that this is the number one options income strategy, and it's just the number one option strategy altogether. There's a reason that institutions and wealth managers that manage tens of millions of dollars of assets utilize this particular strategy to help them add income to a portfolio. So today I want to talk about this strategy that really isn't very sexy. You know, a lot of options traders, you want to trade more advanced strategies, you want to trade butterflies and iron condors, but there's a reason that this simple strategy belongs, in my opinion, of every single portfolio. So today what I want to do is I want to break down this strategy, walk you through the concept of the strategy, the actual nuts and bolts of the strategy so that you understand how to implement it, and then show you the tools that are available to you here at OptionsPlay that will allow you to automate and facilitate trading these strategies on your portfolio. So let's go ahead and get started. But before we do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll talk about cover calls at a high level for anyone here who's not familiar with the cover call so that you understand it from a conceptual perspective. But I always think the best way to learn is to go through a real example. And we're going to use an example of a stock that's currently in the market. We're going to look at some different cover calls and understand what are considered optimal cover calls. Because even for those of you that have traded this strategy or are familiar with this strategy, you might find that cover calls, there's too many choices. And the question that I always get asked the most is, which cover call do I choose? So I want to show you the income reports that we have available to you that help you select the optimal cover call, and talk a little bit about how to manage these trades once you're in this, once you're in the trade itself, and go through some live examples before we open this up for Q&A here at the very end. But the primary thing that I want to help you as a viewer walk away from at today's session is a clear understanding as to how can I generate additional yield on a portfolio using a covered call strategy. So before we jump into it, I want to ask the audience here a quick question. How many of you are familiar or traded a cover call before? Please bring up your chat window at the bottom of your screen, and please type 1 into the chat window if you have traded a cover call or familiar with cover calls, and please type 2 into the chat window if cover calls are brand new to you. Okay, so I see a lot of 1s, but I also see quite a few 2s. So for those of you that are familiar with cover calls, you know, we're going to go through a quick review. But for those of you that are new to cover calls, we're going to make sure you understand the strategy before we move on to the specifics. So just to discuss what a cover call is. It's an income generating strategy, but as we dive into the specifics of the strategy, you're going to learn that it serves another purpose. And that other purpose is actually, in my opinion, more important than the income part of the cover call. The income is a really nice to have aspect of a cover call, but it's not the primary reason that we sell a cover call. So we're going to go through an example and show you the difference between an equity investor and a cover call investor. But essentially, it's a strategy for anyone who has stocks in your portfolio. So how many of you own stocks in your portfolio? Please type yes into the chat window if you own some stocks in your portfolio. Okay, I see a lot of yeses because, again, almost everyone that's viewing this today probably owns some stocks in your portfolio. And usually we think of those stocks as the stocks in our portfolio provides 2 things. It provides capital appreciation if the stock rises in value, and it provides dividends if the stock that you own has a dividend yield or pays a dividend. Those are the 2 things that you receive from that asset that you own, which is a stock. So today what I want to show you is how you can take that asset that you already own in your portfolio and show you how you can extract more yield from it while doing something that you already are doing using another strategy, but that doesn't give you any income. So what we're going to teach you here today is selling a cover call, which is selling a call option against a stock position that you own. Now, when you sell a call option against the stock that you own, what that's going to do is it's going to obligate you to sell the stock at a specific price sometime in the future. Now, think about it. You own the stock because you are hoping that you're going to sell the stock sometime in the future and potentially make a profit. Does that make sense? Please type 2 into the chat window if that makes sense to you, right? That's why you own the stock. You think it's going to rise in value and you want to sell it at a higher price sometime in the future, take profits, and during the time you hold on to that stock, hopefully you'll also be able to extract some yield. So typically this is in the form of a dividend, but today what I'm going to show you is how you can add yield to that dividend yield so that while you hold on to that stock, while you wait for the stock to rise, you can extract more yield from it. There's one limitation there of cover calls though, is that you can't do this for every stock position you have. You can only do it on stock positions where you own at least 100 shares of an optionable stock. So the stock needs to have options listed on it, and you need to own at least 100 shares before you can trade the strategy. Does that make sense? Please type 3 into the chat window if that makes sense to you. Perfect. Okay, so like I said, I'm going to use an example here of Eric B, currently trading at $103. This is a stock that recently broke out above this 98 100 crown level, broke out, came back to test this level as support, and is continuing higher. So perhaps this is the type of stock that you own in your portfolio. And this stock pays a pretty nice, roughly 2% dividend yield. So maybe you think the stock is going to go to 110, 115. And while you hold on to the stock, hoping that the stock rallies to a higher price, you get paid roughly 2% a year in dividends for holding on to that stock. Not a bad outcome, right? So today what I want to show you is an example of selling a cover call on Eric B and show you what type of expectations that you can come out of that. So when you're selling a call option, what it's going to do is it's going to allow you to collect premium, because the person who purchased the call on the other side, the premium that they pay for that call option, you receive as the seller. And then as a seller of a call option, 2 possible things can happen. Either the stock reaches your target strike price, or the strike price that you agreed to sell your stock at sometime in the future, or the stock doesn't reach that target price and you keep the income from the cover call. Just to be clear, in both scenarios, whether the stock reaches your target price or it doesn't reach your target price, in both scenarios, you earn the income. The difference between the 2 scenarios is that if it reaches your target price, you've now sold your stock at that price and you profit from the underlying stock. If the stock doesn't reach your target price, then you still own the stock and you get to keep the income from the cover call. Does that make sense? Please type 4 into the chat window if that makes sense to you. And I would say, for most traders or investors at this point, they are still, they still understand this conceptually. The one thing that I think most investors are not quite familiar with is how much yield, how much income can you actually receive from selling cover calls. Like I said, the dividend yield on Eric B is just shy of 2%. What you're going to find is cover calls typically will average a yield that's larger than the dividend yield. So you're usually going to capture more than 2% from the cover call for the strategy that we're going to discuss. And we're going to show you how much income that you actually receive. So let's say I own 100 shares of Eric B, and I own the stock at 100 crowns. So I bought 100 shares of the stock at 100 crowns. And let's say I think the stock is going to reach 112.5 crowns. So I think the stock is going to rally to 112.5. If it reaches that price, I'm going to be a happy investor because I've made a 12.5% return on my investment, and I get to collect any dividends in the meantime that I hold on to that stock. So what I want to show you is two possible ways to achieve this. You can either be an equity investor, which everyone here that says that you own stocks or in your portfolio, you are an equity investor. And then what I'm also going to show you is what an options investor would do. So as a regular equities investor, when you buy a stock at 100 and you think it's going to reach 112 and a half, you would simply place a limit order at 112 and a half and you would wait. It could take a week, it could take a month, it could take a year for the stock to reach your target price, but you set your limit orders, and when the stock reaches that price, you've sold your stock for a profit. Now, as an equity investor, your risk doesn't change. So if you bought something for $100 a share, your risk is 100 crowns a share. Your risk is going to be 100 crowns a share. And your potential reward is going to be the difference between where you purchase the stock and where you sell the stock. So if you bought for 100 and sell for 112 and a half, your potential reward is 12 and a half crowns. So you're risking 100 crowns to try to make a roughly 12 and a half crowns. Now, if let's say on the other hand, we're an options investor, what can you do as an options investor? We're learning about cover calls. So what you can do is you can sell, in this particular case, a February 112 and a half crown cover call. And for selling that cover call, you're going to collect 1 crown. So what you're going to see here is that that 1 crown that you collect starts to shift a few things. Number one, it reduces your risk, because instead you bought the stock for 100 crowns, now you've collected another 1 crown on top of that. So your total risk on the stock is reduced to 99 crowns. And at the same time, your potential reward is increased to 13 and a half crowns because you've collected 1 crown on the trade. So when you start selling cover calls, you immediately start shifting the risk to reward ratio on the equity position that you own in your favor. And in both scenarios, you're waiting for the stock to rise to 112 crowns, 112 and a half crowns. And during that time, in both scenarios, you will collect the dividend yield. But in the cover call example, you can collect 1 crown per month as long as the stock does not reach your target price. So if by February the stock doesn't reach the 112 and a half crown, you keep the $1. You can sell a March 112 and a half crown cover call and maybe collect $1 more. So while on the equity investor, you only collect dividends, on the option side, you collect dividends and roughly 1 crown a month in addition to that. Does that make sense? Please type 5 into the chat window if that makes sense to you. And I specifically used a stock that was trading around 100 crowns to make the math a little easier to understand, because if I'm collecting 1 crown per month on this stock, then I'm collecting roughly 1% per month in income. Now, how does that compare to the dividend yield? Remember, I was showing you that this stock pays a 2% dividend per year, which means that if you own 100 shares of Eric B, you would roughly collect 2 crowns for the full year. Here with the cover call, you're collecting 1 crown in a single month. So what that translates to is a yield that is 6 times higher from the cover call versus the dividend yield. A lot of times people think of cover calls as a marginal amount of income. But I will say, earning 12% a year is not a marginal amount of income for the assets that you already own, because this is not asking you to take on more risk to try to earn a 12% yield. You already own these stocks in your portfolio. So you might as well try to extract an additional 12% in addition to what you're currently collecting from the dividend yield by selling cover calls. And this is why this is the #1 option strategy in the world. No matter what market you're looking at, it doesn't even matter whether you're speculating or income, cover calls is the #1 strategy for this very reason, because you don't have to add additional risk to your portfolio in order to extract this income stream. Does that make sense? Please type 6 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of 6s, okay? And we're gonna go through more examples to try to make sure you fully understand this. But I wanna do an experiment. I wanna ask everyone a question here, right? So we look at Eric B. It's currently trading at about 103 crowns. Now, think about when you place your limit order, right? When you place your limit order, the further away you place your limit order, the further the stock has to rally before you take profits on the stock. So when you sell a cover call, what I have is 3 choices here: the 112 and a half calls, the 110 calls, and the 107.5 calls. So when I sell the 112.5 calls, that collects 1 crown in income. If I sell the 110s, that means I'll sell the stock at 110. I'm going to collect 1.5 crowns in income. And if I sell the 107.5 crowns, I'm going to collect 2.5 crowns in income. And you can see these are the annualized returns, right? So 1% yield roughly for a 1 crown is going to be roughly 12% yield for the year. The 110s will be almost 1.6%, which annualizes out to 19% for the year. And then if I sell the 107.5, this has a raw return of 2.27%, meaning I'm earning 2.27% over the next month. And if I do that month after month throughout the whole year, that annualizes out to about 27%, more than double what I'm collecting here, right? So I want to ask everyone here, if you had to choose a cover call to sell on your portfolio, which you own this Eric B stock in, which choice would you go for? 1, 2, or 3? Type your answer into the chat window. 1, 2, or 3. Okay, so the answers are starting to come in, and the answers are, as I expected, most people either select 1 or 3. And I would say that the answers are almost half and half. Half of you say 1, half of you say 3. And there's a couple of you that said 2. Okay, so great. I'm glad that everyone put in their answers. So I will tell you, we have back tested these strategies across every single possible expiration date and strike price to see where do you get the most return in the long run with this strategy. And it may be surprising to most investors that you actually have the most return from this strategy using selection number 1, the 1.5, the lowest return strategy. Why does that actually create the highest return in the long run? It has to do with the fact that if you choose the 107.5 versus the 112.5, yes, you are collecting 1.5 extra crowns in income. And that sounds like great, right? Why wouldn't anyone want 1.5 crowns in income? But what you're giving up is 5 crowns in upside. Remember, the stock that you own is what makes most of the return of those 2 components, right? You own a stock because you think it's going to go higher, and you get some dividends in the meantime, right? Or you get some yield in the meantime. But remember, how much you earn from the stock moving higher is typically substantially more than what you can earn in income. And even with a higher income stream from cover calls, you're still not quite overcoming what you can potentially lose out on. So what this means is that when you collect an extra 1.5 crowns, when you sell the 107.5s, that's not worth it because you're giving up 5 crowns in upside. So if you bought the stock at 100 and the stock rallied substantially, would you rather sell your stock at 107.5, or would you rather sell your stock at 112.5? And I think most people will answer, I'd rather sell my stock at 112.5. And what I'm saying is that losing a crown and a half in income per month is worth it, because once in a while the stock makes a big move and you're going to collect $5 off of that, 5 crowns off of that, and giving a crown and a half up, a month is not worth it for you in the long run. Does that make sense, everyone, as to why this is the number one, based on our back testing, this is the clear winner whenever you're choosing cover calls, to choose the higher strike price, the lower income, because you actually get more gains from the underlying stock. If that makes sense to you, please type yes into the chat window, because this is the most important lesson to learn if you're thinking about adding cover calls to your portfolio. I cannot tell you enough how often people choose these lower strike prices because they see these big annualized numbers. They think to themselves, yes, I want 27% return. However, what you end up doing many of those times is that sometimes you have a good month, maybe earnings comes up or something happens and the stock rallies substantially. But guess what? You don't participate on it because you said, I'd rather have an extra crown and a half in income, and then you lose out on 5, 10 crowns in upside. So this is really where we choose low probability of strike prices that have a low probability of the stock reaching those prices. So if it does, you're going to capture a big move in the underlying stock, you capture some dividends, and again, 12% yield, nothing to sneeze at, considering you already are only, you're currently getting roughly less than about a tenth of that, or an eighth of that from the dividend yield. So if you can get 13% on a stock that you're currently only getting 2% on, that's something that's worth looking into. Okay, so that covers what I wanted to share with you. And so what I want to show you is the report that we offer to all Nordic investors that will allow you to actually implement what we're showing you here today. This is the NASDAQ Nordic optional cover call report. And as you can see in this report, what we provide to you are the specific expiration dates and strike prices that have already been optimized for you. So we're choosing these 20 delta call options. So the call options that the stock only has a 20% chance of being above these prices, and how much yield you can actually collect from them. And you can see many of them are collecting anywhere from 1.5 to 2.5% on the higher end over the next roughly 2 months or so. And these annualize out to anywhere from 10 to 15% yield. So let's just take a look at a specific trade. And you can click on one of these links here on the right-hand side to see these trades. So let's take a look at some of these stocks. I'll pick a lower price stock just because you're more likely to own 100 shares of this. So let's look at Embracer. I know a very popular stock for traders these days, around 100 crowns per share. Let's say you own this particular stock. When you click on it, it'll show you that you can sell the 105 cover call on a stock that's currently trading at around 88 crowns, 88 crowns. So if you sell a 105 crown stock, you're going to collect, in this particular case, 2.37%. So 2.37% you're earning in the next 60 days. Compare that to a stock that if you own, you're getting paid 0 dividend yields. So this allows you to quickly understand, okay, if I own the stock, first of all, the stock's not doing particularly well, so maybe capital appreciation is not my top priority right now. I'm hoping to extract some yield. Well, here you can yield about 15% while you hold on to the stock, a stock that's not performing particularly well. Maybe you own the stock, but you think it's going to rally back towards, some of these higher levels, and you're waiting for that to happen. Well, while you wait, you can earn about 15% yield on this stock while you do so. So this is something that is worth paying attention to if you own some of these stocks, especially stocks that do not currently pay any dividends. And you can use this report that's available it's updated once a day. So you have the updated prices every single day. It gives you the exact expiration date, the strike price. It gives you the raw return and the annualized return. The raw return tells you how much yield you collect over this period of time. And then if you annualize that over the full year, that's what the annualized return tells you, so that you can quickly determine whether this is a symbol that you want to sell cover calls on. And I tell investors, you should just go down this list and find stocks that you own in your portfolio. And I would imagine that if you go down this list, you're going to find some stocks. Maybe you own Swedish Match, maybe you own Nokia, maybe you own, I don't know. There's so many stocks that these are stocks that you probably have in your portfolio that you can quickly look for, see which expiration date and strike price makes sense, and click on the link and open the trade-in OptionsPlay so that you can analyze how much yield are you collecting on the cover call, how much dividend do you collect currently owning that stock, and whether or not selling a cover call makes sense on that portfolio. So this is designed to try to make your life a ton easier than having to go through individually one by one, pulling up a stock that you own and seeing if it makes sense that you can sell a cover call on, finding those cover calls manually. This does the work for you. It automates it so that it makes your research process from a few minutes down to just a few seconds. So with that, let's lastly explain what to do once you're in a cover call. How do you actually manage these calls? Well, once you sell a cover call, 3 things can happen. The stock can either move substantially higher, it can move sideways, or it can move substantially lower. So usually, in the example where the stock moves substantially higher, this is really where a lot of cover call investors tend to panic, because you see that the cover call that you've sold has an unrealized loss. So you think that you're losing money, but in reality, you're not losing money, because every dollar that you lose on a call option, you're making back on the underlying stock. That's why it's called a covered call. It's the losses are covered. So this is really where I see a lot of investors tend to panic. And the best advice that I have for you once you sold the cover call, if it rallies sharply, is to not do anything. You want to hold on to that position, and you have a choice. As you get into the last week or two before expiration, you can either buy back the call option if you think the stock will keep moving higher, if you think that there's more upside, or you can roll that cover call in the last couple of weeks. Either way, you want to wait until the last couple of weeks before you do anything. You don't want to do something early and then for the stock to potentially come back lower. And then what you've done is you've locked in a loss that you didn't have to, that you could have just held on to that trade. So whenever the stock rallies significantly higher, practice some patience, wait until the last week or two before you do anything. Now, if the stock moves sideways, this is your best case scenario. You can hold this trade to expiration, or you can simply roll it about a couple of at 21 days to expiration, so 3 weeks out from expiration. Those are your two choices. As to which one you choose, it doesn't really matter. It really comes down to your schedule and how frequently you can manage the cover call portfolio. Some traders don't have time. I say for those of you that don't have time, make your life easier. Sell cover calls every 2 months, and this is something you only have to manage once every 2 months. For those of you that manage your portfolio every day or every week, maybe you might want to be more active. If you're more active, you can extract a little bit more yield. But aside from that, it really just depends on how frequently you have the time to do so. And lastly, if you sell a cover call and the stock drops substantially, this is the only time where it makes sense to do something early. And the rule of thumb is that if you can buy back a cover call that you've sold for 20% of the original premium, then it's time to sell, and it's time to buy back your cover call and sell a new cover call. So if you sell something for 5 crowns, if you sell a cover call and it's 5 crowns, and it's now trading for 1 crown, so 20% of the original cost of the call option, then it's time to simply buy back the call option and hopefully sell another cover call for perhaps another 5 crowns so that you can collect more premium a little bit faster than you originally anticipated. So those are the 3 possible scenarios of a cover call and how to go about handling each one depending on where you are. So with that, that covers what I wanted to share with you here today. I hope that this was helpful in giving you a better understanding of the strategy itself and why cover calls are the #1 options strategy altogether, not just for income strategies, but for all option strategies. And hopefully this gives you a little bit more insight as to how you can apply this to your portfolio and maybe just understand that how widely you can apply this to portfolio and just really understand how much yield you can extract, because I think a lot of investors have a misconception that cover calls are boring, it doesn't give you much yield, but compared to the dividend yield that you currently own on the assets that you have in your portfolio, many times it's triple, 4 times, 5 times, 6 times yield that you're collecting from the dividend that you can get from a cover call. So at this point, what I'll do is I'll open this up for Q&A. I'll answer as many questions as I have time for here. If you can type your questions into the Q&A section, I'll try to answer as many questions as I have time for. There's a chat window and a Q&A window. Please type your questions into the Q&A window. For those of you that are looking for the report, we do email you the report every single week, but for those of you that want access to it now, you can use this link here, which I will post to everyone in the chat window. You can use that link to access the report. Are options usually available on mutual funds? No, I can tell you for certain that there are no options ever on any mutual funds. What deltas are the back tests you mentioned done at? So we did every single delta from 50 down to 5 in 5-step increments. So we tested everything from 5 delta, 10 delta, 15 delta, all the way through 50 delta for our back tests. There's a question here asking, but over time, what happens if the stock rallies and the expiration comes and you still want to have the stock? Great question. So if you sold the cover call and new information comes out and the stock rallies substantially, and you think that that stock can move substantially higher, well, then it's time to buy back your cover call. So if you think that the stock is going to go higher than you originally thought it was going to go, buy back the call, and you can sell another call at that point if you choose to do so. I tend to always sell cover calls on my stocks. The bigger the stock can move, the more I'll sell cover calls, because cover calls is really a way of taking profits. The income is secondary, but the most important part is actually the ability to take profits when the stock rallies. Jasmine, both Avanza and Nordnet, are suitable brokers in my opinion. Fairly inexpensive brokers for you to execute these trades online. So both of them are suitable, Nordnet or Avanza. Any other questions? I'm not sure what you mean by how do I handle the payouts from the company. If you're referring to dividends, usually depending on your broker, you should have a choice of whether you want to automatically reinvest those dividends into the stock itself, or you simply take them in cash. That's a question for your broker. A lot of investors typically just roll those dividends back into the stock, so they'll just effectively buy more stock with that dividend. When selling cover calls. I don't know what you mean by handle the payouts. The credits are immediately credited to your account once you've sold the cover call. So the income is in your account as soon as you sell the cover call. But it also means that you immediately have the obligation to sell the stock at that specific price. So you capture the income unless you buy back the call option, which you're going to have to pay some premium in order to buy back that call to remove the obligation. Yes, you must own at least 100 shares of a stock before you can sell a cover call, because each contract you sell is the obligation to sell 100 shares of the stock. So you cannot sell a cover call unless you own at least 100 shares. 60 days to expiration usually optimal for cover calls. I tend to find that 45 to 60 days in the Nordic market is the optimal, because if you go shorter dated, the premiums are lower. And because of the commissions are still on the higher end in the Nordics compared to, let's say, the US markets, going out 60 days, you're usually able to capture enough premium to overcome your commissions. If you go 30 days, you might find that a lot of times you're paying most of the premium in commissions. How do you deal with early assignment? Well, you don't really deal with early assignment, because if you get assigned early, the stock's gone, right? But usually you should think of early assignment as not a bad thing, because it just means that you're able to capture your profits sooner than you were actually expecting to capture it. In the case of a cover call. In other strategies, it's different, but at least for a cover call, I don't necessarily think of it as a bad thing. And you should not think of your stock being called away in a cover call as a bad thing, because you've already established when you sell a cover call, I'm comfortable selling my stock at this price, because that means I'm going to make a profit. And while I wait for that, I'm going to extract 10, 15% yield while I wait. And then if the stock rallies 12.5% in the month, like in the example that I showed you in Eric B, I'm okay for a stock to rally 12.5% for me to take profits and then roll that profits into the next stock that has another potential of moving another 12.5% in the next month. So a lot of investors, say that, I want to hold on to the stock for the long run, and that's okay if you want to do that. Maybe the cover calls doesn't belong on every single stock that you own, but from my perspective, especially as an active trader, I usually don't own stocks for years and years and years. I like to trade in and out of them because they go in and out of seasons. But the buyer of the call option either buys the stock at a lower price right before dividends, So Mikhail, I mean, the buyer of an option is almost always a market maker. So they're not exactly, a buyer of an option because they will immediately hedge their portfolio or hedge their call option. Jasmine, unfortunately, Avanza is the one brokerage firm that we currently do not have a relationship with. But the one thing I will show you is that when you click on the income tab, if you click trade, we have this short code that you can copy and paste into Avanza. This short code you can copy and paste into Nordnet or Avanza, and you'll be able to find this specific contract, the February 122.5 call option for kind B. If you just copy and paste this short code, which you will find if you click on the trade button for any strategy on OptionsPlay. If you click on the trade button, there's this short code. You can copy and paste the short code to find this specific contract for you to sell that cover call in Nordnet or Avanza. Any other questions? There's a question here. Are there any brokers for multi-leg strategies? There absolutely are. In the Swedish market or the Norwegian or the Nordic market, the best broker for multi-leg execution is going to be Interactive Brokers. Some of you might be familiar with them. I know a lot of you that are more active trade with them. They're lower costs in terms of commissions, and they can you can trade multi-leg options for the Nordic markets with Interactive Brokers. So I would recommend Interactive Brokers for those of you that are interested in multi-leg execution. Okay, with that, that covers the questions here for today. I really hope that this was helpful in giving you a better understanding of covered calls and how to go about implementing them. And if you have any questions, please feel free to send us a question. You can do so using the Questions Ask Us button here on your platform. That'll go to our customer service team that will be able to help you with your support questions around options and the platform. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week on our next market outlook session where we will go over the broader markets. Thank you so much and have a great trading day.